Hello and welcome to yet another episode of the Healthcare India podcast. And as you know, we've been focusing mostly on allopathy, mostly on B2B and the state of healthcare in India. And today I'm going to talk about our IPO that's coming out. It's pretty exciting. It's probably one of the last major hospital chains to go public. And this is the IPO of Manipal Health Enterprises. So, Manipal Health Enterprises, or Manipal Hospitals, as we know, is not just another hospital listing or just another healthcare listing. It's a signal of where Indian healthcare is headed: consolidation, scale, capital efficiency. That's what this IPO signifies. But most importantly, this is not a turnaround story. This is a story of a highly efficient platform that is coming to market. And that distinction is very, very important. Full disclaimer: I'm an alumni of Manipal. I studied at Manipal, one of the most prestigious healthcare institutions, and the hospital is an offset of what the education system achieved. So, what is Manipal really selling? And when I say Manipal, I mean Manipal Health Enterprises. Please don't misunderstand and think that this is the town in coastal Karnataka where the education institution is based. This is Manipal Health Enterprises, and we're going to keep referring to this as Manipal. So, at this core, Manipal is selling a scaled multi city, high acuity tertiary and quaternary care platform. What is tertiary and quaternary? Those of you who watched my earlier podcast would know tertiary is multi organ systems, inpatient, and quaternary is super specialization. 47 hospitals, they're thereabouts, seeing the acquisitions they've made in the last couple of years. 12,000 licensed beds. This is as per their draft red herring prospectus that they have filed with SEBI, out of which around 6,200 to 6,700 are operational beds. All this data that I'm telling you is partly uh, from the draft red herring prospectus. Also, my understanding of the system of the healthcare system over so many years. It's backed by Temasek Holdings. They are the majority shareholder of Manipal Health Enterprises. And also, this is not a typical business where you look at number of beds and make. I mean, I've seen a lot of analysis done on number of beds, but this is almost a 1,000 crore clinical platform with very, very strong output, outcomes, and immense pricing power. Now, why now? Why is the IPO coming out now? Number one, all of us know it's a typical healthcare story. The disease burden is increasing. The disease burden is also changing. We are moving from infectious diseases to chronic lifestyle diseases, which are not life threatening but do have an impact on the quality of life. Number two, insurance penetration in the country is deeply increasing. I think we're up to 10% on private insurance, and if we add all the government schemes, we are up to about 60%. Now, what that means is you have pricing support. So you have sustained demand coming from lifestyle diseases, you have pricing support coming from insurance penetration. And what has happened because of private equity infusion into our hospitals, especially the large corporate chains, is that we have liquidity events that keep coming up every 5 to 7 year cycles. Now, this IPO is, like I said, it's not a turnaround story. This is at the crux of operational maturity, not early growth. So this is not an organization that is in its early growth stage. It's operationally very, very mature. So what you're buying into if you subscribe to the IPO or you pick up the shares in the open market post the IPO is you're buying stability, predictability, but not steep upside curves. The difference is when you buy early stage growth IPO or someone that's just started out their growth journey, you're buying into steep incremental growth cycles. But here it's operationally very, very stable. So this is not going to be a steep growth cycle. Now, just like everybody else, and I've seen a lot of videos, a lot of posts about it, the numbers are looking strong for Manipal. Almost 65 to 67% bed occupancy. This is crux of what the draft red herring prospectus states. But also, it's my estimate that that's the number. Below 60% would have been a worry. I think 67% roughly on the upper side is it's a very strong operating number. The RPOP is also relatively on the higher side. There are chains with better RPOP. RPOP is average revenue per occupied bed, but we are looking at about 70%, 70,000 rupees per day as RPOP, which is pretty strong. EBITDA margins of around 25 to 27%. So you already see this is premium mid-range. This is not the highest on the premium. It is not lower in the premium. It's somewhere mid-range. Now, return on capital employed so far is around 25 to 27%, which shows strong capital discipline. This is not a reckless group. It's never been reckless. So most hospital IPOs were always about improvement. And I saw that we see that trend, across. I don't want to name hospitals, but you can look across the hospital chains and see this is what has happened. But in Manipal's case, it's operational optimization. They are already highly optimized. Now, from a competitive positioning, the only other name that comes to mind is Apollo. Apollo has been there longer. There are quite a few others. Narayana, Fortis, Max. Max is an outlier, but this is not about Max. This is about Manipal. Positioning wise, Apollo has always talked about an integrated ecosystem. They have digital 24 bar 7, labs, so many other things. Narayana is cost leadership done very, very well on cost efficiency plus international growth. Remember, Narayana is present in quite a few other countries. Fortis is mostly urban, mostly premium. Manipal is it's a balance. It's a balance between premium, clinical depth, and very efficient. The valuation for the IPO now we can go about somewhere at 8,000 crore IPO. Some say 5,000 crore. Let's assume it's 6 to 8,000 crores. Valuation range will be anywhere between I think 45,000 crores to 60,000 crores. That's my estimate. I'm a clinician, so if I get the numbers here and there, don't come after me. Revenue is about 9,000 crores roughly. And this is as per the prospectus. EBITDA is 26%, like we discussed, and the EBITDA in absolute terms is around 2,300 to 2,400 crores, which makes it very, very good. A 22 to 26x valuation, which is very high, but that's the nature of the game right now. So this is almost in the range of fair to full pricing, right? Uh, it's a it's not a very deep value entry. Lot of my investment banking friends would say, or investors would say, but it's definitely looking at 60,000 crores as valuation. And remember, this is the last hospital undergoing an IPO. Now, what will actually drive returns? And this is, I'm saying more as a clinician, more as somebody who watches the industry. I don't think Manipal's about margin expansion. That has already happened. They've really optimized, right? And they can grow, they can add new beds, they can add more locations, but I think they are very optimized at this stage. But what this will be about is case mix shift. Now, this is a new term, so let me just bear with me. Case mix means what kind of cases are coming to the hospital. Is it oncology, cardiology, transplants, complex cases? Because that's why Manipal will score over the others, right? If it's not a complex case, you don't need to go to Manipal. You can also deal with a single specialty hospital, which is something that we'll come to in our next few episodes. RPOP expansion. Can I get the case mix, payer mix, and pricing right? RPOP is already high, 60,000 to 70,000 per day. But can I get that? Can I optimize that? And there are some chains in India that have optimized it further. Can I make disciplined acquisitions? One of the criticisms or critiques of Manipal has been its acquisition of Sahyadri. Very high valuation. Now, can I not aggressively go after bed addition, but can I look to further enhance value with what I have? Now, growth in this sector will not come from number of beds. I keep seeing this discussion on number of beds, number of beds. Number of beds means nothing. What required is the quality of the revenue. That means your case mix, your payer mix, your bed utilization, which should be about 65%, right? Now, what do a lot of the risks that investors underestimate in these cases is one is healthcare hospitals, corporate hospitals in particular. There's a huge doctor dependency. It's not the brand, it's the doctor. The doctor is the brand. The doctor drives the patient, especially in complex cases, especially when it comes to higher value case mix. So there is a revenue concentration risk with certain doctors. And this is across cities in India, across geographies, across hospitals. Second is there's pricing pressure from regulatory caps. We already know DPCO plays a role. Immunotherapy, for example, for oncology, which is used, the rates are capped. We had the similar issue in 2017 because of stents. So pricing pressure will always be there because of regulatory cap. Three is acquisition integration mix. What I mean by that is now this is across the board, any industry, you pick up an acquisition unless you can integrate it successfully, both in terms of people, process, technology, doctors, etc., it'll not work. And Manipal has a lot of acquisitions, especially in the west and the east of the country. South, they're relatively strong. They have just one acquisition of Vikram Hospital. But in the east, they acquired Amri, Medica. In the west, they acquired Sahyadri, which I already discussed. So I think there is a risk if the integration doesn't go right. Last is payer mix. If the payer mix is not right, there is going to be volatility. When I mean by payer mix is how many insurance, how many schemes, what kind of schemes are they, central government schemes, PSU schemes, state government schemes, etc. This is a very human capital and infrastructure centered business with operational complexity, right? If I look at it as a business, as opposed to say tech or any other business. Now, from a valuation perspective, uh, EBITDA is 2,300 crores to 2,500 crores. Roughly multiples is 22 to 24x. Valuation could be anywhere between 55,000 crores to 60,000 crores. Now, on the upside, if the EBITDA does go up to say 2,700 crores, the valuation can go up to 65,000 crores as a potential. If the EBITDA goes down to 2,000 crores, then you're looking at a 44 to 45,000 crores as valuation. So this is the role of EBITDA. That's why operational efficiency is going to be the key when you look at an entity like MHE or Manipal Health Enterprises. When you're evaluating the IPO, focus on these few things. Number one, just remember that occupancy is already optimized. A 67% optimization uh, among operational beds. I think where else can you go? Maybe 70%. It's very difficult to eke out 1% increase over this. Margins already strong. So the group has been doing well. ROCE is, I think, return on capital employed is, I think, one of the best in class so far, at least as per the numbers are concerned. Remember, this is not a publicly listed entity, so a lot of my information, whatever I'm telling you, is based on what I have seen and what I've read in the prospectus. It's a high quality, execution sensitive compounding story, not a turnaround story. So if you're expecting that IPO will come and money will come and things will turn around, it will not happen, right? Because there's no turnaround here. There's nothing to turn around. The ship is already sailing very well. If priced aggressively, I don't know what's the IPO band. Maybe I'm missing. So I don't know. I don't know the story there. Maybe the investment bankers underwriting this will know. If it's aggressively priced, there's going to be limited upside. If it's priced fairly, then it's a strong long-term hold. Remember, a lot of the money that is going to come in through the IPO is going to pay for the Sahyadri acquisition. It's going to look at all the new hospitals that they're building. Remember, a new hospital, when it comes up, it takes about 3 to 5 years for it to be profitable or at least go critical and making operating. Also, it's going to be pay for a lot of the new technologies that they're going to implement to enhance their case mix. Manipal, the IPO is not a bet on hospital demand. That is already there. It's a bet on sustaining long-term premium pricing, clinical quality, which is undoubtedly there, and capital discipline at scale across 47 hospitals. So let me know your thoughts. As always, feel free to reach out. This is my take as a clinician who's watching this industry. If there's a different take, especially from those of my friends who are deeply into numbers and finance, let me know. Happy to discuss, happy to debate. As always, please do subscribe to the Healthcare India podcast, both on Spotify as well as on YouTube. And looking forward to staying in touch.